Welcome back to the Deep Dive. Today we're diving into a really high-stakes story, Nebius Group, ticker's NBIS.
Yeah, and it's a company that's, well, it's growing incredibly fast, but the stock, it's actually trading in the lower part of its estimated value range right now.
Exactly. It's this pure bet on AI infrastructure,
Yeah.
huge potential, but, massive challenges too. And a valuation that's, well, it's definitely up for discussion.
Definitely. So by the end of this, you'll really get why it's such a fascinating, almost textbook high-risk, high-reward situation.
Our mission today is really to cut through that noise, right? We've got this comprehensive research report, and we want to pull out the key nuggets. Can this company, born out of, frankly, geopolitical chaos, actually become a global AI infrastructure leader?
That's the core question. It's innovation versus some pretty incredible odds.
Okay, and just before we jump in, if you're getting value from these deep dives, please do us a huge favor, hit like and subscribe on the Stock Analytics AI YouTube channel. It genuinely helps us make more of these.
And don't forget, members get priority access to our S&P 500 deep dives. We're hitting all of them over the next few months, so it's a good time to join.
Absolutely. Or if you just want one specific company covered, drop us a superpower.
Okay.
Right. Let's get into it. Chapter 1, Business Analysis. So first things first, who is Nebius Group, NBIS? What's their actual business?
Okay, so Nebius is what's often called a neocloud company. Think of it as a new breed, hyper-specialized. They're not trying to be everything to everyone like the big cloud providers.
Right.
Their main thing is GPU as a service, GPUaaS. Essentially, they build these massive data centers, pack them with super powerful GPUs, the kind you need for serious AI training, and then they rent that computing power out. As of July 11th, 2025, the stock's sitting at $44.30.
And the money comes from, how do they actually generate revenue here?
Mostly usage-based. Customers pay for the compute they use. Plus, there are recurring subscriptions. The big metric everyone watches is their annualized recurring revenue, ARR.
And that's the one that's been climbing rapidly.
Climbing isn't the word. It's soaring, accelerating month over month. It shows they're not just getting customers, but getting them fast. And those customers are likely sticking around.
Okay, but here's the thing that gets really interesting for me. Why would someone choose Nebius just for raw power over, say, AWS or Azure, which offer this whole huge ecosystem of services?
That's the core of their gamble, isn't it? Specialization. See, the hyperscalers, AWS, Azure, Google Cloud, they offer everything. Storage, databases, analytics tools, the whole shebang, which creates really high switching costs,
Yeah, you get locked in.
Exactly. Nebius, with their Nebius AI platform, offers pure raw compute power. But it's not just any power. They've got the latest NVIDIA H100s, H200s connected with InfiniBand networking.
Which is like a super fast connection between the GPUs, right?
Precisely. Think of it as a dedicated highway just for the GPUs to talk to each other super efficiently. Combine that with tools like Kubernetes to manage it all. Their platform is built specifically for these massive AI workloads. They even got selected as a launch partner for NVIDIA's next-gen Blackwell chips. Wow, okay.
So they're betting that for companies really deep into AI, that raw performance and, crucially, cost efficiency will beat the convenience of the all-in-one giants.
But you mentioned earlier, Nebius isn't only a cloud company. There's this other layer to it.
Absolutely right. And this makes valuing them a bit more complex, maybe more interesting. Nebius Group itself is a holding company.
Okay.
So besides the main AI cloud business, they hold significant stakes in other tech ventures. Almost like a mini VC portfolio tucked inside.
Like what?
Well, there's Toluca AI. They do data solutions. Actually got investment from Jeff Bezos' fund. Then Triple Ten, which is in EdTech. A Ride doing autonomous driving spun out of Yandex. And a big one, a 28% stake in ClickHouse.
ClickHouse, the open source database, that's huge now, right? Multi-billion valuation.
Exactly. And this structure isn't just random, it's strategic. They can crystallize ClickHouse to generate cash.
Ah, so they use that cash to fund the main AI cloud business. Precisely. It gives them non-dilutive funding. A war chest, essentially, to fuel that super aggressive AI build-out without constantly selling more Nebius stock and diluting existing shareholders. It's quite clever in this capital-hungry space.
So size-wise, where do they fit in? Still tiny compared to the AWS behemoths.
Oh, yeah, compared to the hyperscalers who dominate the overall cloud market, they're small. But they're a very significant challenger in the neocloud space, directly competing with players like CoreWeave.
And they're building out globally.
Aggressively. Data centers running in Finland, France, Iceland, Kansas City in the US. Another huge one is being built in Vineland, New Jersey. Their long-term goal, 1 gigawatt of power capacity. That's massive scale.
So let's boil it down for the customer. What's a core value proposition? Why pick Nebius?
Okay, 3 main things. 1, cost efficiency. They claim their whole full-stack design, everything optimized, gives customers a 20–25% lower total cost of ownership for AI stuff. That's a big number.
Definitely.
2, performance and specialization. Because they only do AI infrastructure, it's tuned for it. Better performance than general-purpose clouds for those specific tasks.
Makes sense.
And 3, regional sovereignty. They're really pushing this European AI cloud leader angle for European companies worried about where their data lives or just wanting an alternative to U.S. providers. That's a major plus.
Okay, let's unpack the market itself. What's actually driving this incredible demand for AI infrastructure?
It's an explosion, really. The market's projected to go from maybe $30–60 billion in 2025
Wow.
to potentially $124 billion, up to maybe even $500 billion by the early 2030s. We're talking compound annual growth rates of 18%, maybe even over 30%.
What's fueling that?
A few things. Enterprises shifting to cloud-native AI, the rise of AI, the edge think devices, and just the sheer amount of money the hyperscalers themselves are spending. Over $300 billion projected in 2025 CapEx. It's a tidal wave of investment.
And who are the main competitors Nebius is facing in this gold rush?
2 main groups. Indirectly, the hyperscalers, AWS, Azure, GCP, trillion-dollar companies, deep pockets, existing relationships. Although, interestingly, sometimes they become customers of neoclouds. Microsoft's big deal with CoreWeave is a prime example.
Right, that was huge.
Then you have the direct competitors, the other neoclouds. CoreWeave is the big one people compare them to, but also Lambda Labs, Crusoe Energy. It's fierce competition there for capital, for engineers, and critically, for getting enough NVIDIA chips.
So how do they stack up? Nebius versus CoreWeave versus the hyperscalers.
It's a contrast. Nebius pitches its full-stack tech, cost-focused, strong balance sheet, and European base. But they're unprofitable, burning cash, have that geopolitical history, and maybe lower customer lock-in. CoreWeave has more scale right now, very tight NVIDIA ties, big contracts. But they also have high debt, customer concentration risk, and maybe some lingering crypto bro image issues from their past.
And the hyperscalers.
Massive scale, profitable, integrated ecosystems, but they're less specialized for pure AI performance, potentially more expensive for the specific workloads.
What about the regulatory side? Any specific winds blowing for or against Nebius?
It's mixed. Data sovereignty laws, especially in the EU, definitely help Nebius with their European focus. That's a tailwind. The big potential headwind, geopolitics, specifically potential U.S. tariffs on hardware. We'll definitely circle back to that. It's important.
And the barriers to entry.
Yeah.
You mentioned capital. Sounds like
So
you need incredibly deep pockets.
monumental is the word. Billions for just one data center. Then finding the talent, specialized AI engineers, cooling experts, network architects, there's a global shortage. And then the big one, getting allocated enough of NVIDIA's latest GPUs. Access is king.
It's almost a paradox, isn't it? High barriers make it hard to get in, but AI tools make it easier for software companies to innovate, create more customers for the infrastructure guys.
Exactly. High barriers consolidate the infrastructure providers like Nebius, while lower barriers on the software side fuel demand for that infrastructure. Nebius is positioned to potentially benefit from both trends.
Okay, so beyond just surviving those barriers, what are Nebius's actual competitive advantages? What's their edge?
Several things. First, brand strength, but in a nuanced way. The Nebius brand is new, just from 2024, but it inherits this deep technical legacy and a really cohesive engineering team, 850 engineers from Yandex. Decades of experience. That buys instant credibility.
Right, the Yandex tech reputation.
Second, those cost advantages we talked about. The claim is 20–25% lower TCO because of their full-stack design. Their Finland data center, for example, has a PUE power usage effectiveness below 1.2. That's incredibly efficient. Less power wasted on cooling means lower costs. Big deal in this energy-hungry business. The caveat, they don't have the bulk purchasing power of an Amazon or Microsoft.
What about locking customers in? Network effects.
That's actually a relative weakness compared to hyperscalers. Offering raw compute makes it technically easier for a customer to switch if someone else offers better price or performance. Retention really depends on them staying the price-performance leader.
And finally, their unique assets.
Yeah, a few key ones. That cohesive engineering talent pool with the shared history. A premier NVIDIA partnership being a reference platform cloud partner and a Blackwell launch partner gives them early access and credibility. And Crucially, that fortress balance sheet. Starting with huge cash, zero debt initially, that war chest is a massive strategic asset in this expensive race.
All right, let's pivot. Chapter 2. Management evaluation. The leadership here, Arkady Veloz and John Boynton. There's a lot of history and maybe some controversy.
There certainly is. Arkady Veloz, the CEO, is a well-known serial entrepreneur. Co-founded Yandex way back, grew it into a $30 billion giant, the Google of Russia, led its NASDAQ IPO, immense operational success.
The geopolitical situation.
Exactly. After Russia's 2022 invasion of Ukraine, he faced EU sanctions, resigned from Yandex. His public condemnation of the invasion came quite late, August 2023. He explained the delay was about ensuring thousands of Yandex employees could relocate safely. It's complex.
And the chairman, John Boynton.
Harvard grad, long ties to Yandex NV, director since 2000, chairman since 2016, co-founded other ventures with Veloz's deep experience.
So the tension is clear operational skill versus this geopolitical shadow.
That's the heart of it. You've got a proven visionary founder, an experienced chairman, undeniable expertise, but you also have the Yandex Russian history, despite the full divestment. That likely puts a discount on the stock valuation. It's something investors have to weigh very carefully.
How have they been communicating since the Nebius relaunch? Transparent?
Since becoming Nebius, yes, communication has been active and pretty transparent. Regular press releases, financial results, partnership announcements. They stress Dutch and international governance standards. But that ethical reputation piece, especially around Veloz's timeline, that's still a work in progress. They need to constantly prove their independence from the past.
Okay, so given that leadership context, where is the company's money actually going?
Yeah.
Capital allocation.
It's incredibly focused, 100% on organic growth of the core AI cloud business. Nothing else really matters right now.
So huge spending plans.
Massive. A $2 billion CapEx plan just for 2025. Building data centers globally, buying GPUs. It's being funded partly by those big capital, raises the $700 million equity round, which notably included NVIDIA and Excel.
That's a strong signal, NVIDIA investing.
Huge validation. And the recent $1 billion convertible note, plus their M&A strategy is all about selling off those non-core assets, like ClickHouse, to raise cash without selling more Nebius stock. Non-dilutive funding is key for them.
What about returning cash to shareholders? Buybacks? Dividends?
Nope. Never paid a dividend, no plans to. And they actually canceled a previously approved share buyback plan late last year.
Why?
To plow every available dollar back into building the AI infrastructure. It screams growth at all costs, like a venture capital-backed startup just on a much bigger scale. Huge potential upside, but also massive execution risk.
The return on all this invested capital, the ROIC.
Right now, negative. Around negative 10% to negative 13%, which is totally expected when you're spending billions before the revenue fully ramps up. The huge question for you as an investor looking at this is, will those future returns eventually justify this enormous upfront cost and exceed their cost of capital? That's the bet.
Okay, let's crunch the numbers. Chapter 3, financial analysis. What does the current financial picture look like?
Market cap is around $10.55 billion as of mid-July 2025. Revenue growth. Well, you can't really look back 5 years because of the whole Yandex restructuring. But the recent story is pure hypergrowth.
Give us the highlights.
FY 2024 revenue was $117.5 million. Q1 2025, $55.3 million. That's a 385% jump year over year.
Wow.
And that ARR, annualized recurring revenue, it leaped from $249 million in March 2025 to $310 million just 1 month later in April. That acceleration is key. Their guidance for the full year 2025 is between $500 and $700 million.
Incredible top-line growth. But profitability must be taking a hit with all that spending.
Oh, yeah. Deeply unprofitable. Operating loss in FY 2024 was $443 million. Net loss in Q1 2025 alone was $113.6 million. Adjusted EBITDA loss in Q1 was $62.6 million, though that was an improvement from the year before.
Is there a path to profit? What's management saying?
This is critical. Management expects to hit adjusted EBITDA breakeven in the second half of 2025. If they achieve that, it's a massive proof point. It shows the underlying business model works. It's not just about growth for growth's sake. A huge de-risking event, potentially.
And free cash flow. Guessing that's negative, too.
Deeply negative. They spent $544 million on CapEx in Q1 2025, alone way more than revenue. That cash burn is being funded by the divestment proceeds and the financings. Positive free cash flow is not on the near-term horizon. They are in maximum build-out mode.
So with all that spending and losses, how stable is their balance sheet? Can they afford this?
They started in an incredibly strong position. Huge cash pile, basically zero debt after the restructuring. The $1 billion convertible note adds some leverage, yes, but overall it's still very manageable because they started so strong. Their current ratio, measuring short-term liquidity, is exceptionally high at 18.0. That's a massive safety cushion. That fortress balance sheet is a real competitive advantage.
Which brings us to valuation. This seems like a really tricky one to value. How do you approach it?
It is tricky. Standard price to earnings, PE, is useless because earnings are negative. Their TTM PE is like negative 24.
Right.
So you look at price to sales, PS. Based on trailing 12-month revenues, it's trading around 67 to 69 times sales.
Which is very high.
Extremely high. It tells you the market is baking in massive, massive future growth expectations. That's the only way to justify that multiple.
So how do you get to an intrinsic value? Do you use a DCF?
You have to really, to anchor it in fundamentals, even though it's more art than science for a company like this. A discounted cash flow model forecasts future cash flows and discounts them back. Our educational model, trying to account for the huge uncertainty, comes up with a wide range, $38 to $62 per share.
What are the key assumptions driving that range?
Massive revenue growth for the next 5 years, getting from maybe $600 million in 2025 up towards $5 billion by 2030, then slowing down. Margins turning positive late 25 or early 26, eventually reaching maybe 20-25% operating margin long term, and a high discount rate, 12-15%, reflecting all the risks. No profits yet, competition, capital needs, the geopolitical stuff.
Okay, makes sense. Let's switch gears slightly. Chapter 4, market sentiment. What is Wall Street actually saying about Nebius right now?
Overwhelmingly positive, actually. The analyst consensus is a strong buy. Average price targets are in the $61 to $67 range, with some going as high as $84. Lots of recent buy and outperform ratings being initiated or reiterated.
But the news flow isn't all positive, right?
Not at all. It's this weird mix. You see headlines about the stunning 385% growth, the successful $1 billion note, the NVIDIA partnership, Jeff Bezos' investment into Loca as validation.
Right, the good stuff.
But then you also see the cautionary notes. The huge cash burn, the lack of profits, the intense competition, that sky-high valuation. It really is, as you said, high excitement mixed with high anxiety. A classic high-risk, high-reward narrative playing out in real time.
What about short sellers? Are people actively betting against the stock?
There's definitely some skepticism. Short interest is around 6.9% of the float. That's moderate, not extreme. The days to cover is very low, just over 1 day, so no signs of a major short squeeze brewing. It just shows a meaningful chunk of the market remains unconvinced or is hedging.
And technically, how's the stock price looking?
It's pulled back recently, trading below its 50-day moving average, which technicians see as a short-term bearish sign, maybe profit-taking after a big run-up, but it's still way, way above its 200-day moving average. The stock is up over 130% in the past year, so the long-term uptrend looks intact despite the recent dip.
Interesting. Okay, let's look inside the company. Chapter 5, ownership structure. Who actually owns Nebius?
Institutions hold a pretty hefty chunk, somewhere between 41% and 44%. Big names are in there. Orbis Allen Gray is the largest. Slate Path Capital, Citadel, Excel.
Any interesting trends in who's buying or selling?
Yeah, there's a real divergence. You've got firms like Slate Path and Morgan Stanley significantly adding to their positions recently, but others like Fred Alger Management and Corin Management have been reducing their stakes.
So even the big money is divided on this one.
Absolutely. It just highlights that risk-reward profile again. Smart money managers are looking at the same data and coming to very different conclusions, making multi-million-dollar bets accordingly.
What about insiders, management, and the board?
They hold about 18.4% of the economic value, but, and this is key, they control over 65% of the voting power.
How? Dual-class shares.
Exactly. The Lasser Trust, which is linked to Arkady Vlose, controls 55% of the voting rights alone. So strategic control rests firmly with the founder and the board.
Any insider buying or selling recently?
No open market transactions reported in the last 12 months. Now, for foreign private issuers like Nebius, reporting rules can be different, but it suggests no major insider moves in the public market.
So highly concentrated ownership. Good or bad?
It's a double-edged sword, isn't it? For common shareholders, your voting power is limited. That's a risk. But it also insulates management from short-term activist pressure. It lets them focus on this incredibly long-term, capital-intensive build-out without constantly looking over their shoulder.
Right. Let's them execute the strategy.
Okay.
Let's pull together the major risks. Chapter 6, risk assessment. What are the biggest hurdles Nebius needs to clear?
We can think about it using SWOT: strengths, weaknesses, opportunities, threats.
Okay.
Strengths, we've hit the differentiated tech, the experienced engineering team, that fortress balance sheet, the elite NVIDIA partnership. Those are powerful internal assets.
Weaknesses.
Weaknesses, still unprofitable, burning cash fast, huge execution risk trying to scale globally this quickly, the geopolitical baggage and reputational overhang, and potentially lower customer switching costs than hyperscalers. Internal challenges.
Opportunities. The upsides.
Opportunities. Riding the massive wave of AI infrastructure growth, becoming that European champion playing the data sovereignty card, cashing in on those non-core assets like ClickHouse for funding, and eventually capturing the shift to AI inference, which is expected to be an even bigger market than training. Huge external potential.
And the threats.
External dangers.
Threats. Brutal competition from hyperscalers and other neoclouds, the sheer capital intensity, the risk of just being outspent, and that critical dependency on NVIDIA for chips. Supply chain disruption is a major threat.
You mentioned external forces earlier. How do things like interest rates or geopolitics specifically impact their gamble? Macro factors are definitely a threat. High interest rates make borrowing for CapEx more expensive. High inflation hits, costs energy, labor, construction. A recession could cause companies to slash AI spending, hitting demand directly.
And the geopolitical one, you flagged those potential U.S. tariffs?
Yes, the proposed 2025 U.S. tariffs on semiconductors and electronics, potentially from China, Taiwan, Mexico. This is a really specific and potentially damaging threat for Nebius.
Why specifically for them?
Because it hits the cost of their core inputs.
Wow.
GPUs, CPUs, servers could increase costs by 5%, maybe up to 25%. This creates what you might call a dangerous pincer movement. Nebius's value proposition is partly cost advantage, right?
Right, 20–25% lower TCO.
But these tariffs would increase their costs significantly. So management faces a nasty choice. Eat the higher costs, which delays profitability even further and means they need even more capital, or pass the costs on to customers, which erodes their main competitive price advantage against the hyperscalers.
That really could undermine their whole strategy.
It's a critical external risk. It could fundamentally change their competitive position. Definitely something to watch very closely.
Okay, let's wrap this all up. Chapter 7. Conclusion. When you put everything together, the good, the bad, the uncertain, what's the final picture?
It really comes down to a balance of extremes. The bull case is compelling. Pure play AI infrastructure exposure, insane hypergrowth, a founder with a proven track record, that strong balance sheet, unique tech, top-tier NVIDIA partnership, and the European angle. Lots to like.
But the bear case.
Equally strong. Deeply unprofitable, burning through cash, facing ferocious competition in a capital-destroying industry, massive execution risk, a very rich valuation already, that geopolitical history, and critical vulnerabilities to supply chains and those potential tariffs. It's a heavy list of concerns.
So going back to the valuation, where does the stock sit relative to its potential, considering all that?
Our educational DCF model gave that wide range, $38 to $62 per share. The current price, around $44.30, is in the lower half of that range. It suggests the market is definitely optimistic, pricing in a lot of growth, but maybe not the absolute best case blue sky scenario just yet. There's still potential upside if they execute flawlessly.
So the final outlook.
Nebius Group is a classic, maybe even extreme, high-risk, high-reward investment. It really boils down to execution. Can management navigate the competition, build out globally without major stumbles, and crucially, pivot from burning cash to generating sustainable profits? That's the multi-billion-dollar question. And maybe a final thought to leave you with, connecting this back to the bigger picture. Given how much money it takes to build this infrastructure and how intense the fight is, you have to ask, how many neoclouds like Nebius can this market actually support long-term? Can they all survive? And if not, what specifically gives Nebius the edge to be one of the winners?
That's a great question to chew on. Really highlights the stakes involved.
Oh.
Okay, if you found this deep dive useful, please hit like and subscribe for the Stock Analytics AI YouTube channel. It genuinely helps us keep doing this.
Yeah, and remember, members get priority access on our S&P 500 deep dives, or you can request a specific stock with a super thanks.
Absolutely. And one final, very important reminder from us.
This analysis was generated by an AI system. It's for educational purposes only. It is definitely not financial advice. Please always do your own research or talk to a qualified financial advisor before making any investment decisions.